Okay, everybody, thank you for being here this morning or afternoon, apologies. I'm glad you guys are here. We're going to start today with our attendance quiz, but I got tired of fighting with the printer. It kept saying printing, and then I go over there, and there was nothing in the print queue. So I tried rebooting. I tried every possible thing. So we're just going to do it on paper, or if you want, you can do it on your computer. Either one is fine. So if you don't have your laptop with you, go ahead, pull out a piece of paper. You can turn it into me, handwritten. If you do have your computer, please go to the attendance quiz for today, 3:30. It's in the chapter 6 module. Oh, no, it's not. Just kidding. Let me add it. It's in the grade book. But alrighty. So this attendance quiz is going to count for 2.5 points on the quiz grade. So each chapter I have the quizzes at 15 points. So now the Connect quiz is 10 points, and then these two attendance quizzes are the other 5 points, so it makes 15, okay? This question, the first part of it, it's the first part of homework question number 17 that was on your chapter 4 homework, and it's almost identical to the statement of cash flows question that was on your practice test and on the actual midterm. So this was one of the most missed questions on the midterm that lost a lot of students a lot of points. So we're going to go over how to do a statement of cash flows. If you studied your practice test, if you went through Emily's videos, if you went through the videos I made to go along with the chapter 4 homework, then this shouldn't have been an issue for you unless you just really had a hard time understanding. If that was the case, please reach out to me or Emily and let us know so that we can work with you one-on-one. If you just didn't do it, then that makes sense why you didn't get very many points. So heads up on that. I'm going to put more cash flows on the final because I need to make sure that nobody leaves this class not knowing how to do a statement of cash flows. So if you already know how to do it, then you are good for a part of the final. If you don't, it's not going away. Statement of cash flows is going to haunt you through the rest of your accounting career, so it's an essential thing that you have to know how to do. Alrighty, so this first question is presenting you with an income statement for Tiger Enterprises, and it has sales revenue at the top. That's the same as sales, and then operating expenses. And they've weirdly grouped cost of goods sold in with the operating expenses. Not sure why. It's fine though. Normally, we would put cost of goods sold, then gross profit, and then the operating expenses. They didn't do that. It's okay. So there's the operating expenses there. Here's the income before tax, income tax, net income. The whole point of the statement of cash flows is to make sense of the fact that this net income number of 1,452 does not tie or match with how much our cash increased. Our income was $1,452, but our cash only went up $140. So if you just came in, I couldn't print it. I don't know why, but if you want to do it on the computer, just go to the assignment for the attendance in the chapter 6 module or write it on a piece of paper. I'll take it. So our cash only went up $140, but our net income went up $1,400. So if you don't understand accrual basis accounting very well, it might be really strange to say, well, if you made $1,452, why did your cash only go up $140? And you and I all have a very quick answer for that, and that is accounts receivable. That's the biggest part of it. That's most of it probably, is that they made a bunch of sales and they still haven't collected them. So that's part. But there's other things too. There's also prepaid insurance, or they might have bought some inventory with their cash. So they might have used some of their cash to buy inventory. They might have used some of their cash to buy some prepaid insurance. Every time we spend cash, it doesn't always have to be an expense. Sometimes when we spend cash, it can go and because we're buying an asset. We might have used the cash to buy some equipment. We might have used the cash to pay off some bills. So we might have paid some accounts receivable, or I'm sorry, accounts payable. It might look like we had some extra expenses that we didn't actually pay, like the income tax, we maybe didn't pay it, so that might actually have increased our cash when we didn't record it as an expense. And we might have got some money from taking out a loan or paying off a loan. We might have sold some stock or purchased some stock back. We might have paid some dividends. So anytime we're doing a cash transaction that affects another balance sheet account, it won't show up in the net income. So the whole purpose of the statement of cash flows is to figure out why we have a different net income number than we have a difference in cash. Okay, so the very first thing we start with is the net income number. So that's where we're going to start. And then the very thing we end with is the cash numbers at the very end. So at the top of the report is net income. At the bottom of the report is the cash balances. There's 3 sections: operating section, investing, and financing section. So today we're just going to do the operating section. The operating section is different than the other 2 because if we did it the way we do the other 2 using the direct method, we would have to comb through thousands or millions of transactions to come up with the number like cash received from customers. We would have to figure out every single cash payment from customers and add them all up, and it could be thousands. And then cash paid to suppliers. We'd have to go through and look up all the payments we made to all our suppliers and add those all up. It's a lot. So instead of doing that, we start with the ending number, the net income number, and then we just like reverse out anything that isn't cash related. That's why the operating section doesn't seem like it makes sense. How about this? You go to the doctor, they weigh you, and they come up with this crazy number, like 297 pounds or something. And you're like, there's absolutely no way. I don't weigh 297 pounds. And they're like, oh, well, that's because you have all this extra, you're holding all this extra stuff. You're holding a backpack. You're holding a bunch of books. You're wearing some like giant heavy boots, and your pockets are full of like coins and money, and it's throwing your weight off. And so you say, oh, that's why this number is so high. It has a lot of extra stuff in it. We got to take it out. And so you make a report that starts at 200, and then you subtract out all the stuff you're holding. Like subtract the weight of the backpack, subtract the weight of the coins, subtract the weight of your clothes, subtract the weight of the books you're holding and the kids you're holding because you have kids with you and you're holding them. And then, oh, now we'll get down to your real weight down at the bottom, which is this number here. So when you read the report of your weight, if you did it that way, it would look like you're weighing everything except you. You're weighing your backpack, you're weighing your change, you're weighing other people, you're weighing books. I thought this was a report of your weight. You're like, yeah, well, it is. Mine's at the bottom. This is all this stuff that I was holding when they weighed me that I had to subtract out. So the report looks weird. It doesn't look like it even includes my weight at all. But it does. My weight's at the bottom. And so that's what the statement of cash flows is. We start with this number that's all got a bunch of extra stuff in it, and then we subtract all that stuff out. And then we get to the real number that's down at the bottom. That's the number we're looking for. That's only in the operating section, though. All right, so here's how you do the statement of cash flows in the operating section. You start with your net income. We're doing the attendance quiz, and I didn't print any. So if you have your laptop, do it online. Otherwise, you can just do it on a piece of paper and turn it in. Yeah. Start with your net income, and then there's 2 things you have to like reverse out. You have to reverse out depreciation and amortization expense, because that shouldn't be in there. That's not part of the cash weight. When we first put it into the net income, we subtracted it. Depreciation is subtracted when you're calculating net income. So to reverse it, we have to add it. So we do the opposite of what we did when we calculated it as part of net income. Now we're going to reverse it back out. All right, and then also gains and losses. So you might have to subtract your gains and add your losses if there are any. And that's because that's not part of operating stuff or your operating cash flow. Those are related to the investing cash flow. So we're going to reverse those out of our net income number as well. So both of these are reversals. And then there's a bunch of things that I kind of went through that we probably spent cash on or got cash from that is not, wasn't measured in the net income at all. And we need to account for that. And that is the accounts receivable, the inventory, the prepaid, the accounts payable, accrued liabilities, and income taxes. What's the date on this? December 31st, 2027, and the notes payable. No, I don't want to do that one. It's all the current assets and the current liabilities. So if accounts receivable went down, see how it started at 870, and pay attention to the dates because sometimes they flip them. So you have to watch that. So if the accounts receivable started at 870 at the beginning of the year and it went down to 770, that means that we got $300 from our accounts receivable from last year, but we got it this year. So we got to add that in. We got to add that into our net income number because it won't be in there. So we've got to add the decreases and subtract the increases in the current assets. So if the accounts receivable or any of these assets went up, that means that we spent money on it to make the balance grow. So like the prepaids, they went up $50. They started at 40 and went up to 90. That means we spent $50 on it. So if we spent money, we need to subtract, then it went up, then that means we used some cash. If the balance went down, that means, here the balance went down, that means we got some cash. So however the assets changed, you have to do the opposite in your calculation to reverse it. And then the liabilities flip. So the accounts payable went down. That means we paid some of it off. So that means we used some cash for that. And none of these balance sheet transactions are included in the net income. So they all have to be like added on as adjustments. So we're going to add and subtract the increases and decreases in the current liabilities. I know it seems like a formula I'm asking you to memorize, and right now it is, but when you get to your job, the first time you make a statement of cash flows, you'll probably be like me. I had fully had 3 kids, and I was working on an audit, and I was making a statement of cash flows, and I had been out of school for like 15 years, and I went, I see what I'm doing. I'm just recategorizing everything that's in the income statement and the balance sheet and rearranging it and putting it in a new report. I just took all the puzzle pieces from the balance sheet and the income statement, jumbled them up, and redistributed them. So we made all these reports from the general ledger, and then we made them all again on the statement of cash flows in a different arrangement in different categories. This is just the formula, and like I said, it doesn't make a lot of sense up front necessarily because it looks like we're doing the opposite of what we should be doing because we are. Because we're starting with the wrong number and we're trying to adjust it to get to the right number, which is at the bottom. All right, so that's what we're going to do today, and the rest of these accounts deal with other parts of the statement of cash flow. So equipment, accumulated depreciation, are in the investing section. Notes payable, common stock, retained earnings, dividends are in the financing section. So that's not what I'm asking you to do today. All right, so there's our formula. And then down here at the bottom of the assignment page, it says to prepare the operating section of the statement of cash flows. So the title always has to go at the top. You put the company name. and what the report is. And then you put the date. Let's see, for the calendar year ending 12/31/2027. Yeah. And then the first section, we call it operating cash flows. And you could do inflows as a positive number or outflows as a negative number, but that's the title of the section. And then at the bottom of that, we'll put our like ending balance number. Total inflows is positive and outflows is negative from operations. And whatever number we come up with will go in that column over there. This is the totals column over here. And this is the details column. It's not debits and credits on a report. It's only debits and credits on a journal entry and a trial balance and a T account. But on the reports, it's the details and the total. And the people who need to hear that are probably not here because I've said that so many times and I still saw it on the midterm. People probably just thought, oh, I got it. And then lost points for putting them on the wrong side. All right. So going back to the formula here. Who wants to start us off with the very first number we need? Yes, it is. And the amount? 1,452. So we're going to start there. So you start with net income. And if it was a net loss, it would be a negative. So we start off with that. One thing you can do is that you can check these off because you're only ever going to use any of these numbers once. Because it's just a rearranging of the information that's already on the balance sheet. So we're not going to need to use it twice. Okay, what's next? Good. How much is our depreciation? And you're getting that from right here, right? 280. Okay, so since we already subtracted it to get net income, what do we have to do to reverse it? Add it. Yes. Okay, so plus depreciation expense. And I don't see any amortization. So that line is done, and I can check this one off because we did that one. Well, that was a terrible check mark. All right, what's next? Accounts receivable. Do we have any gains or losses? No. No, you don't have any gains or losses. So it is accounts receivable. Okay, so accounts receivable went up or down? Down. Okay, so if it goes down, and it was $100, you say? Do we add it or subtract it? Add it. When the assets go down, that means cash has come in from that. Like we've collected the accounts receivable, so more cash has come in. Or we didn't spend the money on it and it went into our expenses and we need to back it back out. Great. Okay, next one. Prepaid insurance, did it go up or down? Down? Okay. And how much did it go down? 50. Do we need to add it or subtract it? Subtract. So all the assets are the same. So if the assets go down, we do the exact same add or subtract. So accounts receivable went down and we added it. So if prepaid goes down, we'll add it. Same thing. Good job. Great. All right. Next one. Yep. Decrease in inventory. They all three went down. I didn't look at it, so you guys tell me. All right. How much did it go down? Increase. Okay. I was like, usually they like mix it up on homework questions, but maybe not. I don't know. Okay. There we go. Increase in inventories. How much did it increase? All right. Do we add or subtract? Subtract. Yes, because the assets, you do the opposite of what the direction is. Because when we collect our accounts receivable, then the accounts receivable goes down, and that means cash came in. So we're adding it to the cash balance. So those are the three current ones. And now we're at equipment, which is long-term. So we're done with the assets. Good? Everybody okay with this? Up. It went, let's see, down, up, up. Yeah? Isn't prepaid insurance an increase? It is. Prepaid insurance is an increase. So you were right the first time you subtracted it. Yep, because these are the beginning numbers on the right, and then these are the ending numbers on the left. So prepaid insurance went from 640 to 700, so it actually went up. So this should also be an increase. Is that 50? Is that correct? 50? The number's right? Okay. And anything else anyone wants to change on this? I think we're done with the assets. All right. Next one. You ready? Okay. What do you want to do? Okay. Great. Accounts payable. Did it increase or decrease? Decrease. All right. And how much? 60? 80. All right. So if accounts payable decreases, do we add or subtract? You subtract. Great. Because the liabilities are on the other side of the equal sign from the assets, so you do the opposite action. So if you're going to increase it over here and subtract, then when you increase it over here, you add. So liabilities, the adding and subtracting flips and changes. So it's opposite of the assets. And the assets are opposite of their direction. I know it's confusing. I remember learning this or trying to learn it. I remember, and I know it's frustrating. But the more times you do it, the more comfortable you'll get, and the more you'll see, oh, it's just the same thing every time. It's like turn on your blinker, check your blind spot, move over, and you'll just do it the same time every time. All right, next one. Ready? You want me to skip you? Yeah? Okay, next one. All right, did it increase or decrease? It decreased. Okay, do we add or subtract? Very good. Okay, and then the next one, you got it? Increase or decrease? Increase. Okay, so and how much did it increase? And do we add or subtract? We add it because it increased. Good, very good. All right, any others? Is there another one? So yeah, I need to check the, hold on. It says 1 year, but we're gonna put it in the investing section. Let me double check here. Yeah. It's going to go in the, I'm sorry, not investing, financing section. It's going to go down here in the financing section. Even though it's a current asset, we're still going to put it in the financing section because it's an interest-bearing note. So that is a special rule for these notes payable. If it's interest-bearing, then it goes in the financing section. If it's not interest-bearing, then it goes up here into the operating section. So that's actually a technical GAAP rule that was being illustrated in this particular problem. So very good. Awesome. Thank you. Okay, so we're done. We're done. There's nothing else that we need to include. We have just to add these all up here. And I think on that screen I was just on, they already did it for us. 1552. So that's this number down here. 1552. All right. So what this tells us is we did not make $1,400 of cash from our operations. That's what our net income was. In fact, we made $1,500 of cash from our operations. So hooray, we did even better than the net income suggests. So our operations are doing very well. This is great news. This is good. We want this number to be as big as possible and positive. That's excellent news. That means the company is doing well and they're healthy and their sales are profitable. Startups, probably not so much because they're just starting out. But in this company, it looks really good. So where did the rest of the money go? Because if we go back and look up at the cash balance, it actually only went up like $140. So where did all the rest of the cash go? If we brought in $1,500, it must have gone somewhere. And we can look around and we can find it. There's $500. We went to pay, buy some assets. And the rest of it must have gone to dividends. Let me pull up the answer and let's see. Yep, there's the rest of it. Almost 1,300 went to dividends. So 500 went to buy some equipment. They got some money from selling stock and getting a loan, but most of the cash went to the investors. So we're like, hey, we did profit sharing with you guys. We made a bunch of money and we gave it to you. So you're welcome. That's where all the cash is. We didn't keep it. We paid it out. All right. Any questions about this? Anybody has? Awesome. Go ahead, submit it on Canvas, and then I'll make sure to give everybody a grade. All right. I have some bad news for you guys. All right. Here's what happened. When I was putting in the extra credit, I put it all into the quizzes category because we had different grade categories. Okay. And there was homework and quizzes until the midterm. And now we have the midterm. Well, everybody was getting hundreds on their homework and quizzes, which is fine. You are allowed to do that. Good job. And we ended up, and this is a hypothetical student. One of the students in the class came to me and was like, hey, something's going on. And they were 100% right. And so I'm going to give you guys some more extra credit, which will make the problem even worse, but whatever. It'll sort itself out eventually. We ended up with this. A hypothetical student gets 100% on their homework, and they've got a bunch of extra credit, but they got all their quizzes. And so then they got 125% on the quizzes, and then they took the midterm and got an 80. So if we look at just that setup, don't look at the rest of this yet. You'll see that the grade, if you add all these categories, all these points up from all three categories, they have 375 points out of 420 possible in the class so far, which gives them a grade of 89. Okay, so that's great. That's fine. However, I had to put weights on the grades to account for this assignments category. So for like the reading assignments, I didn't want that they automatically, when I assign it from Connect, they give you 100 points. I can't take it off. I didn't want that to count towards your grade. Sometimes they put in like extra study materials or attendance when I would take attendance and not graded. And I put them all in this assignments category. especially the ones coming from Connect, we run into issues where you can't just say, don't grade this. And so this assignments category has to be assigned a weight of 0%. Otherwise, it starts affecting your grade when it shouldn't. So based on the class overall, these are the weights that should be assigned to each category. So if you look in the syllabus, those are the weights that go into each category based on the ending points that are available in each category, right? So 15, 15, 30, and 40. So I put those weights in right now. But what's actually happening is that because all the points aren't assigned yet, like we don't have you haven't done all the work for the whole entire class, we only have 420 points finished instead of like 700 or 1,000. And so the weights to date are actually 25, 25, 50 because we've only done these 3 categories so far. So right now, the homework's counting for 25% of your grade, quizzes are counting for 25% of your grade, and the midterm is counting for half of your grade because the 15, 15, 30 translates to 25, 25, 50. All right. I wouldn't go through all this if this wasn't an accounting class. So when you multiply these weights by these percents, you get a grade of 96. So this student right now in the grade book would say they had a grade of 96. But if we ended class today and then we didn't do the final and there wasn't any additional work, their real grade would actually be 89. So the way the student caught this was that when I put in the attendance, the 2.5 attendance points, their grade actually went down like 0.02. And they were watching their grade so close, they were like, hey, how come when I got 100 on a quiz, my grade went down? I was like, I immediately knew what the problem was. I was like, oh no, because every time you get 100 on a quiz, that percent is gonna go down every time. So if I like put in like another 15 points on this and made it 90 out of 75, then this would go down from 125 to 120. So every 100 you guys are getting in your quizzes is actually making your grade go down. Because I know some of you are still confused, but it's because that extra credit was bumping it up. And so when you get hundreds, it's pulling this percent closer and closer to 100 every time you get 100. So here's what I'm going to do. I'm not going to bump it to this because this isn't valid because those extra credit points are still points that count. What I'm going to do is I'm going to switch the category for the extra credit from the quizzes to the midterm. Okay, so what that will do is it'll give everybody a boost on their midterm for those extra credit points. So even if you got 100 on the midterm, it's never going to make your grade go down because you're not going to take another midterm, right? Well, it's going to level it out where it is. It's going to give you those extra credit points on your midterm instead of the quizzes. So now when you get hundreds on quizzes, it's not going to make your grade go down like a little bit every time you get a good grade on a quiz. I apologize for this. I did not anticipate this being an issue, and I should have. I guess I'm used to teaching students that don't get that good of grades on quizzes. So I'm going to have to revamp my methods. I'm going to move those extra credit points to your midterm. So your grade will drop a little, but just because right now it's inflated, not because there's anything wrong. When we got to the end of the class, if I left it in quizzes, it would even out, but your quiz grade would get closer and closer and closer to 100 every time you take a quiz until the end of the class. And then by the end, everything would be fine. So I did like a little scenario here showing what it would look like with the weights on this hypothetical student. So here they've got the way the weights currently are with the extra credit in the quizzes. But if I move the extra credit down here to the midterm, you can see the actual grade based on points is still 89. but it drops from a 96 to a 93 because it makes this quiz percent drop from a 125 to a 100. But it boosts the midterm from an 80 to an 85. And it's the difference in percentages is just because there's so much more possible in the midterm category than in the quiz category. So instead of letting your grades slowly go down all over the rest of the semester as you do good, I'm going to move all the extra credit to the midterm and just do that one-time adjustment. So and I'm sure the people who aren't here will email me and I will have to try to explain it again. But that's what I'm going to do. And so the grade will go down a little. In this case, it went from a 96, because I worked it out, it went from a 96 to a 93. So it went down about 3% when I moved the extra credit. But this is the actual grade that would be after you finished all your quizzes and got to the end. It would eventually get down to a 93 anyway. All right. Apologies. I will work with Connect and see if there is a better way to do the extra credit so it doesn't overload those weighting categories, or maybe take the weights off in some way so the extra credit is just like pure extra credit points, not in a category. And then at the end, the categories are all in the right percentages by the end of the class. I'll see what I can do, but this is what I'm going to do for now. If you have an issue, I apologize for this. So sorry. So sorry. Okay. All done. Questions? I'll answer any questions. Yes. Do you want me to do it right now? Okay, I'll do it right now. Okay, hold on. I have to blank everything. So let me go. Okay, so I did that, and then I'll give everybody 5 more points in the extra credit for being bad at calculating this the first time. All right, there. So that should be the updated grade. Now, do you have questions? It looks, what I see on my end is that a lot of students whose final grade was above 100 is now in the high 90s. That's the main thing that happened on my side. But if yours fell significantly, I'm sorry. Ugh, another math problem to solve. All right, any other questions now? Anybody? All right. Okay. So, yeah. Oh, it said it was due on Friday. You can try. We'll see what happens. Yes, go ahead, do it. All righty. So we need to finish chapter 1 from last time because we didn't get finished with it. We were working on revenue recognition and how you know when you're allowed to recognize revenue. And we were talking about how there's two different paths to revenue recognition. And in some situations you recognize the revenue right away, and in other situations you recognize the revenue over a longer period of time. So let's keep working on this. So we're still in the day one notes. We haven't moved over to the day two yet. So we're still on the day one. All right, I believe we're right here on the page 3, correct? Yes, okay. All righty, so we're right here. Allocating a contract's transaction price to multiple performance obligations. And the question that we have here is, how should a contract's transaction price be allocated to each of a contract's performance obligations, assuming that there are more than one? And when we have a contract with multiple performance obligations, that's when we run into situations where we might have to recognize some of the revenue right away or at a single point in time, and some of the revenue over a longer period of time. And specifically when you're buying an object or a piece of hardware with a subscription related to it. So the item itself would be recognized at the moment that the buyer takes control of the asset, and then the subscription or the warranty would be recognized over a longer period of time. So when we get paid, if we get paid up front, it gets recognized as unearned revenue and then gets switched to regular service revenue or warranty revenue or earned revenue of some kind as we earn it. Same goes for gift cards. We sell the gift cards in advance, but we didn't actually provide anything, so we don't record the revenue until the gift card actually gets used to buy something. So how do we split the price of the bundled sale items? So here's our definition here, our answer. The allocation is based on the standalone selling prices, and it has to be proportional. The standalone selling prices must be estimated if they're not normally sold separately. We can't just recognize all of the subscription revenue up front so we get revenue immediately. That is attractive if you want to have a boost to your net income. You might want to say, hey, this is a subscription revenue, but we want to recognize all of it today. So we're going to just discount the phone, and then the subscription price is not discounted, or it is discounted, and so we recognize all the revenue up front with the phone itself. We can't do that. They have to be split proportionally. And we call each of these different revenue items that we have to put a price on, we call these performance obligations. And that's what the seller has to provide to the buyer for the money that they're paying. When is a promise to transfer a good or service a separate performance obligation? First, it has to be distinct and separately identifiable. So you have to know what it is and how you can identify it and differentiate it from some other good or service. And it has to be something that people can buy. So a streaming subscription is a thing you can buy from multiple different streaming platforms. So that counts as a separate performance obligation if you're selling some hardware with a streaming subscription attached to it. The second one says it's separately identifiable and not highly interrelated with other goods and services in the contract. One example of this would be QuickBooks software, which accountants use a lot, especially for small business accounting. QuickBooks is a really, really good option for small businesses. And they sell standalone installations that you can install on your computer. And they also sell cloud subscriptions. However, neither one of their basic QuickBooks platforms comes with the payroll extension or payroll add-on. If you want QuickBooks to do payroll, you have to pay for that separately. However, if you don't pay for payroll, your QuickBooks works just fine. It just doesn't do payroll. If QuickBooks didn't work without the payroll add-on being purchased, then they're too highly interrelated. One or the other has to be able to work independently in order for them to be two separate performance obligations. And then here are some examples of some contract terms that are never considered to be separate performance obligations. And this is because they don't transfer a good or service to the customer. You're not actually selling an item or a service. They are things the seller has to do. So sometimes students might think, oh, it's a performance obligation because we are obliged to do this action. We have to do this. It's required. However, because they don't transfer a good or a service to the customer, then they aren't considered separate. And when they're not separate, that means we don't have to price them. So every performance obligation has to be priced. So we know if we record the revenue today at one period of time or over a period of time. Those are the two things. But we don't price these things. We don't price prepayments. So if the prepayment is required in some way or authorized in some way or allowed, that's not separate. It's not priced. Rights to return are never priced. So if you say, yeah, you can return this in 30 days, we're not going to put a price on that to recognize revenue on that option we're giving the customer. And the third one is normal quality assurance warranties. So there's the normal warranty, like for manufacturing defects. And then there's the extended warranties of like, you just used it a lot and so it broke. And so we'll cover that too. Those are extended or warranties related to use. Well, normal quality assurance warranties are related to manufacturing defects. So like when your car gets a recall or something like that, and you have to take it in and they replace a part, that would be a normal quality assurance warranty, and we're not going to price that separately. Okay, does that make sense? Because we're going to do an example here in a minute. We're going to start identifying performance obligations and putting prices on them. Okay, here are some that are always separate performance obligations. Extended warranties and preferred customer perks and discounts. So if we are selling membership to our Sky Club, and that means that you can go to our club at the airport and have a drink and some dinner while you're waiting for your plane, but only special members get to do that if they fly a certain number of miles or they pay a certain premium, then that means that's a separate performance obligation, something that we're giving the customer. We're giving them access to our special club, and they have to do or be something special to get it. If everyone gets it, it's not special. So it's not a separate performance obligation. It's just part of it. I can't think of any examples of like special, I guess honor students, kind of. Can you guys take honors classes if you're not honor student, or are they restricted? I think they're restricted. Okay, so let's say that the university says, okay, we're going to offer honors courses to honors students, and they have to be special qualified in the honors college. They do the application and get admitted. So we can't we have to price that as a separate performance obligation, or business students, I guess, because you have to apply to your major. Every major has its own application process. Once you get into your major or your school, then you're allowed to take classes that people from other schools are not allowed to take because they didn't apply and get their special treated status. But gen ed classes, everybody can take gen ed classes. So those aren't special. There's no separate performance obligation for that. That's good for everybody. So here's an example. Allocating the transaction price, that's the name of the question. I put the title of the question from the back of your books. If you go to the end of chapter 6, you'll find these questions in there. On 8/1/2027, ABC Company sold software to a customer for $80,000. In the contract, ABC will provide quote unquote free support services for 6 months. Okay, we all know it's not really free. It's part of the price. It's included. It's not a separate free thing. It's all one bundled together. So we're not selling software for 80 and support services for 0. We're not doing that. That's not what we're doing. That's what GAAP wants to avoid. They call it free, but it isn't. What we've done is, in the accounting terms, under GAAP rules, what we've done is we've discounted the software and we've discounted the support services, and those two prices added together are 80. Our job as accountants is to split those two apart and figure out what each one is, because the software gets recognized immediately and the support services get recognized over time. So we have to be able to split that 80,000 apart between the two performance obligations. The software only costs $70,000 without support. Okay, so there's a huge clue right there. And the standalone support normally costs $30,000 for 6 months. What's the journal entry that ABC should use to recognize revenue for 2027? All right, so here is how we do this. It has to be proportional, and we're going to use the standalone prices to figure out the proportions. So that's the standalone prices, 70 and 30. So that, if those are our two standalone prices, they add up to 100,000. And to get the 70%, it's 70 divided by 100,000 and 30 divided by 100,000. So the total standalone is 100,000. So to get the 70%, we'd do 70,000 divided by 100. And to get the 30%, we'd do the 30,000 divided by 100. And then what we do is we're going to take those percents and we're going to apply them to our purchase price, to the 80. So 70% of the 80 is for software, and 30% of the 80 is for support. I'm going to redo my arrows and do them a little different. So that, there, there. Okay. I think I did the math down here already. Yeah, 56 and 24. Okay, so this one is 56,000 and this one's 24,000. So those two together add up to 80. This one's the 70% and that one's the 30%. So that's how we're going to assign the 80,000. That's how we're going to split it between the software and the customer support services. So the 56 gets recognized right now because that's the software. So they're taking the software. That's fine. That you have that. We did our performance obligation for that, and then the support for 6 months, we have to recognize that over 6 months. So here is how we would do the journal entry. We're going to recognize all of the sales revenue because they already gave us the cash. So we'll do all the sales revenue for the software. And then since they gave us the cash for the support as well, but we haven't done the support, that one has to go into deferred. And then we'll recognize that later over the next 6 months. The deferred revenue will slowly get turned into services revenue. So now I'm going to pull up a question from the test, from the midterm. And you'll probably recognize this one. And I think we talked about it last time too. All right, is this question. On 9/5, a company signed a year-long contract to provide services to one of its customers. The customer paid 20% of the contract price at the time of signing. Record the journal entry the company would make on 9/5 under accrual basis accounting. So on this question, all of it is deferred. This only has one performance obligation, and it's a service contract over a year. So there's only one. So all of it is recognized over time. There's no current portion to recognize. And so a lot of students, and like I said, I think I said this last time, a lot of students wanted to do this. $100,000, and then they put cash in at $20,000, and then weren't sure what to do with the other 80 and kind of got lost right there. That's because in this problem, it's only 20 and 20. They only gave us 20%. That's it. That's all they gave us was 20%. So that's all we record right now. Later, we're going to earn some of that 20,000, and they're going to give us the rest of it. And the other transactions that come after could get far more complicated. But right now, all they've done is give us $20,000 for work we didn't do yet. We're going to do it. There's a contract. But it doesn't matter what the contract is for unless they actually gave us the money. So compare that question to the one we're just working on in the notes. This one, they gave us all the money. They gave us all the 80,000. So because they gave us all of it, we have to do the deferred revenue and the sales revenue split for all of it. And that test question would have been different if they'd given us the full 100. Then we would have recorded the full 100 as deferred if they had given us all of it, but they didn't. They only gave us 20. Questions? Okay, moving on. All righty. So now how do we know if a contract even exists? Now we get to be attorneys at this point and learn a little teeny bit of contract law, sort of. It's GAAP contract law. So here are the two rules according to GAAP that let us know a contract exists. One, it has commercial substance, and that is a fancy lawyer way of saying money value. So a contract to hand you a piece of trash is not a contract because it has no value, I guess. I mean, sometimes art is questionable in my opinion, but other people find it very valuable. And so I'm not here to judge what other people find valuable, but I think it would have to be something that a court could like argue and say, yes, this does have value, so this is an enforceable contract. All parties to the contract are committed to performing the obligations. It doesn't mean you actually have to. You just have to be committed to. Like you intend to. You're not, it's not a con. You're not tricking anybody. You didn't just like not read it. You knew what you were doing and you intend to do this. and you're going to sell this to this buyer, and the buyer is intending to pay you for what they receive. If the buyer doesn't know that they're buying it, it's not an enforceable contract. If nobody's figured on a price, it's not an enforceable contract. All right, so here is a example question. On 9/15/2027, ABC Company delivered on a contract to sell products to XYZ for $100,000 free on board destination. Okay, this matters. The free on board destination matters because that tells us when the buyer is going to take possession and ownership of the items. When they get to the buyer is what that means. So if this is an Amazon delivery, the seller owns it until it arrives at the buyer's doorstep at the destination. So we, as a seller, can't record any revenue until the items get to the buyer's delivery point. The cost of the goods in ABC's inventory was $72. So that tells us that we are making $28,000 in profit on this sale. So that's our cost of goods sold. ABC thinks that the probability of XYZ actually paying on the contract is slightly more than 50%. So go back to my paragraph up here. All parties to the contract are committed to performing the obligations. So as the seller, we think that the buyer is slightly more than 50% committed. So the question in this particular scenario is, does that mean they're committed or not? What is the journal entry that ABC should make upon delivery of the products, assuming no payment has yet been made to recognize revenue under GAAP? And the answer is none. If it's slightly more than 50, GAAP says they're not committed. It has to be more than slightly more than 50. And there's the reason this is a question is because there's a difference with IFRS. And it has, and GAAP is vague with these like percentages on a lot of different things. Like with the large stock dividends and the small stock dividends, they're like, it's about 20 to 25%. And they don't have like a hard line. They give you judgment. Slightly more than 50 doesn't pass the test in GAAP. It has to be a lot more than 50. And honestly, there isn't a rule. So if I wrote on the test 80%, is that a lot more than 50? Raise your hand if 80% is a lot more than 50. Yes, I agree, 80%. What if I say 55? Is that a lot more? Probably not. So let's go with 60 for the class. If it's more than 60, that's a lot more than 50 in our world where we're at. This is a judgment call that CPAs would make, and accountants would make, and auditors would make, and the SEC would make, and FASB, court, things like that. If you're close to the line, don't do it. If you're like, ooh, I think someone might not like this, probably don't do it. You know, like, what's the definition of cheating on your boyfriend or your girlfriend? Like, what's the definition of cheating? I don't know, but I know when I see it. Like, if it's someone else, it's different than if it's me. Or if I don't know. Like, that's kind of the vibe we're at here. Like, yeah, question? You are. But GAAP doesn't have a definition of committed to paying. It just has to be a lot more than 50. If you're 100% sure, oh bless you, if you're 100% sure they're going to pay, then you're fine. I don't know, like some like behind door talks and deals. Maybe you're a gambler. Maybe you're like, I mean, if they pay, that'd be sweet. Let's go for it and see if they'll do it. I don't know. Yeah. All right. So, yeah. They didn't. They would probably just guess. They would probably get an estimated delivery date when they put it to ship, and they'd use that date. Almost certainly that's what they did. And before they could do that, they probably just used like 5 days or 3 days. As long as they were consistent, it would have been industry standard at the time. So if everyone's doing it that way, then that's fine to do it that way. Yeah. So it has to be likely. That's the word they use. Likely. Slightly more than 50 isn't likely. So here's the same question under IFRS. Oh, well, and this is actually upon delivery. So we already did our part. This is even after we delivered it. We still can't do it. Even after we delivered it. So then under IFRS, I guess if you already delivered it, maybe they would call you and they would be like, we're probably going to pay you slightly more than 50% chance. Yes. Yes, of course you can sue them, of course. But when we're making the financial statements, we don't want it to show up as revenue if we're going to have to sue them to get it. So that's the issue, is that we're not even going to put it on the books as revenue if there's that much of a chance it's not actually going to be cash or collected. Okay, so IFRS is slightly different. IFRS made a bright line in the sand. They said if it's 50 or more, go ahead and record it upon delivery. You're good to go. So we deliver it. If we're using IFRS, then it's fine. You can do it slightly more than 50%. This question is definitely on the CPA exam because this is an easy way to test students' nitty-gritty details about the difference between IFRS and GAAP. And IFRS and GAAP revenue recognition is the biggest difference between the two standards. So IFRS said, yeah, that's fine, you can record it. But here's how we do it. So we put the receivable in for 100 and the sales revenue in for 100. So we get all the revenue, and then we put in our cost of goods sold and our inventory. So these first four, this is our normal inventory sale journal entry. This is how we always do inventory sales. It's just super normal. They all look like that. IFRS says, okay, we let you do that, fine. But now the rest, the money you think you, like the percent unsure you are, has to go as an offset in the allowance in the bad debt account. And then if you do end up collecting it, you have to reverse that. So it's unlikely they're just going to collect 51,000. The probability, that's one of the problems with probabilities. They're either going to collect it or not. They're probably not going to get half of it. So if they collect all of it, then they'll reverse this. If they don't collect any of it, then they have to write off the rest of it. And that's what GAAP doesn't want. We don't want these reversals when things change. GAAP wants everything to be known and like settled before you record it. GAAP doesn't like these like, oh, whoops, I guess it turned out we did get the money. We'll have to reverse that bad debt. Or, oh, I guess we didn't collect it after all. So now we have to write it all off. We want to avoid that in GAAP. So that's why GAAP doesn't allow you to do this if it's only 51%. It's not allowed. Questions? All righty. So this one's asking us how many performance obligations are in this example. ABC sells fitness subscriptions online for $50 plus $5 a month. How many performance obligations exist in the implied contract when a customer registers for services? This is called an implied contract because you don't sign a document that says contract at the top. And most transactions are implied contracts because we don't sign a piece of paper that says, I will give you and you will do this. Now, they do have the terms and conditions. However, a lot of that isn't legally enforceable when you're dealing with a multinational corporation with like in-house attorneys and someone on the internet. However, there's only one performance obligation here. It is let them use their website. Give them access to the website. There's only one. Even though the price is split, $50 up front, $5 a month, it is one performance obligation. We just have to give them access to the website. That's it. So we only have to do one price. So the full price, the 50, will be spread out over a year. And then we'll also add on the additional $5 a month. So this first one, it's either or. It's either all at once or over a period of time. And since there's the $5 a month, it has to be over a period of time. So all of it would be over a period of time. Warranties. Oh, and in fact, the question title calls it a prepayment. Warranties. A company, this is also a prepayment. A company sells phones with a 1-year warranty that covers manufacturing defects for $500. Okay, that is a basic warranty that is included in the price of the phone. That's not a separate performance obligation. So we don't have to price that defect warranty. ABC also sells a 3-year extended warranty that covers breakage or maintenance. The price of the extended warranty is $75. Okay, this is a separate performance obligation that we have to price. So the phone is $50 and this is $75, but we don't get that $75 as revenue. It's unearned until the 3 years are up or we do the work. So we get to recognize the $500 today and the $75 at the end of the warranty period, or when we actually do the warranty work, whichever is first. So that one has to wait until later to be revenue. It's just going to sit in deferred revenue for 3 years. How many performance obligations? Delivery of the phone to the customer. We've got the defect warranty is never a separate performance obligation. Oh, this should say, oh, the first. The second one is the warranty. That's the second performance obligation. It's not part of the phone purchase because it's bought separate. All right, and then there's 2 more here. So this one's the same as the last one, except they're giving them a discount if they buy the warranty at the same time that they buy the phone. So if you buy the phone today, we'll give you a discount on the warranty. If you wait, then you have to pay full price for the warranty. So in that case, it becomes a bundle. Now we've got the phone and the warranty bundled together, and we have to allocate the price out. We're going to have to do some percentages and allocate the price out, because if there's a discount for being special, then you have to split the price according to the percentages of the original prices. Defect warranty, never a separate performance obligation. And then the last one, it gives them unlimited renewals at half the price. That's a second performance obligation, but you wouldn't record any revenue for this discounted renewal that happens in the future unless they do that in the future. So for today, you just do the revenue for whatever services they buy today. And then if there's a discount in the future, you'd record it then. All right. Thanks, you guys, for being here. We're going to finish chapter 6 next time. Have a good afternoon. Bye. Thank you for this. I'll mark it down. Does anyone else have any of the attendance on paper you want to turn in to me for points? Bring it up and I'll do that.
for
Uh-huh.
the quiz number 4. Is it possible for me to like redo it because I got one question wrong and it's 3.
Oh, yeah. If you send me an email, I'll do it for you. Yeah.